financial HR. The quickest way to double your money is to fold it over and put it back in your pocket. When we talk about financial HR, we talk about quantifying the workforce. Traditionally, people have been seen as a liability. When you ask a director, would you like to have fewer or more people, they say fewer people. Why? Because if fewer people can do the job just as well, they don't cost me as much money. So people are a liability, and HR is perceived as a fee burner, as opposed to sales, for example, who are the fee earners. When a sales professional made a big deal, they walk through the company as if they are the hero, as if they are bringing in all the cash, and in fact they actually are bringing in all the cash. Whether they're a hero, that's debatable. What you see is that bringing in money and creating a return on investment, that's what the business is all about. Money is the language of the business. And what we're going to look at in this lesson is, hey, how can we quantify intangible decisions and show their effectiveness? Because if you're able to do that and to do that really well, every HR decision you make, you can judge based on the return on investment. You can say, hey, is this a smart and is this the right decision to make? And if the return on investment is positive, then it is a good decision to make because you get an actual return on your invested capital. And if the return on investment is negative, then you should change something about your proposal, or you should change something about what you're doing in order to either quit the project or to generate a positive return on investment. So in this lesson, you'll learn more about financial HR, about how to calculate a return on investment, and use activity-based costing as a way to estimate the cost of a project. How to calculate a return on investment? Well, a return on investment is basically the net benefits divided by the total cost. And the net benefits are the total benefits minus the total cost. Let me give you an example of how to calculate an ROI. You walk on the flea market and you see a beautiful painting. And it's sold for $100. You buy the painting and you then sell it via eBay for $300. What's your return on investment? Now, it's not 300%. It's not 100 divided by 300. No, it's your net benefits divided by your total cost. So you say, hey, my net benefit is the $300 in total benefits minus the $100 of total cost. So my net benefit is $200. My total cost is $100. So your return on investment is 200%. Now 200% makes sense because your investment is $100, your return is $200, that's what you get back in your pocket. So your return on your $100 investment is $200. So your return on investment in this case is 200%. Keep in mind when you calculate an ROI that you calculate with the net benefits divided by total cost and not your total benefit divided by total cost, which is a mistake that a lot of starters make. So your return on investment formula is your net benefits divided by your total cost. So in this case, the return on investment is 2 or 200%. Now let's look at a different example of a case that could just come across your desk by tomorrow. What's the return on investment of a training program? Your company is struggling with absenteeism. Hiring a trainer to organize a long-term training program to reduce absenteeism will cost $30,000. 50 managers will participate for 8 hours a month for 12 months. Would you advise the board of the organization to organize this program? Yes or no? Take a few minutes to write down your answer and focus specifically on what kind of extra information you need in order to give a good answer to this question. And remember what I just said about calculating an ROI. Now pause the video and write your answers down. As you have figured out by now, you need more information. Why? You don't know the total cost of absenteeism and you need to know the benefits to calculate the return on investment. You don't know how much the time of the manager is worth, for example, so it's hard to calculate the total cost of the project. Here you see the more extensive business case with more information. A long-term training program is expected to reduce absenteeism by 10% for your company. Okay, so that's a reduction of 10%. That's good. What's the total cost of absenteeism? The total cost of absenteeism was 1.25 million. Hiring a trainer was, as you saw, $30,000. A total of 30 managers will participate in the training for 8 hours a month for 12 months. Average pay for a manager, including benefits, is $60 an hour. So the big question that remains is, what's your advice to the management board? Now, this is a basic business case which has all the information you need. So what I would like you to do is take the same piece of paper, turn it around, write down the total benefits, write down the total costs, calculate the net benefit, and then divide the net benefit by the total cost to calculate your return on investment. So I would say take another 5 minutes, maybe even 10, to calculate this. Pause the video in the meantime, and then continue after you've calculated the return on investment for this specific case. Let's first examine the total cost. First of all, we have the trainer, which is a one-time expense of $30,000. We then have the time that 30 managers need to put in. 30 managers times 8 hours a month, times 12 months, times the $60 that they earn including benefits, is $172,800. Other costs that we didn't include in the business case are the cost of training material, but let's assume that's in the 30K of that we pay the trainer. Facility costs, finding the right location to facilitate the training. Changes in the day-to-day job of the manager. For example, if the managers learn a specific intervention to tackle absenteeism, that changes their jobs and probably makes them more busy, so you have additional operational expenditure, and you have other costs. In the case, we saw that there's an estimated reduction of absenteeism of 10%. The total cost of absenteeism is 1.25 million US dollar, so 10% of that is 125K. In order to calculate the total benefit, we need to have an understanding of how long these benefits will last. Now let's say that we have a maximum benefit for 3 years and then the effectiveness of the intervention stops. So in that case we say 125K times 3, so that's 375K US dollar. The total cost of the program is, added everything together, $202,800. So the net benefit in this case is $172,200. So if you then calculate the ROI, you end up with an ROI of 0.85 or 85%. And that's a decent ROI. And this is just the financial ROI of absenteeism costs that are lowered. And you also have a number of soft benefits in this case. For example, increased happiness because people are not ill, lower stress, less increased workload, etc. So this is a basic way of having a business case, acquiring more information about the financial numbers, and then saying, hey, is it interesting, for example, to start with this training? And the answer in this case is yes, because the net benefits are positive, and if we divide it by the total cost, we actually have a positive return on investment. If the total costs were greater than the benefits, then we would have a negative return on investment, and it wouldn't be a wise decision to pursue this specific training to reduce absenteeism. In this example, we applied activity-based costing. We identified all the activities that are related to the intervention, and then we calculated the cost of each activity. We said the managers need to participate in the training. They are $60 an hour including benefits. So their total expenses are, and then we came up with a number. And we did that for all the activities related to the intervention. And that's how we were able to come up with a return on investment. It's a very nice and structured way to calculate the effectiveness of HR interventions and HR policy. When you do this, it's always important to differentiate between ongoing expenses and one-time expenses. So to say capital expenditure, which is a one-time expense, and your ongoing expenses, which are your OPEX, your operational expenditure. Why? Because ongoing expenses keep on going. Over time, they keep on adding cost to the project. And one-time expenses, for example, in this case, we had a trainer in year 1 who was 30K. That's a one-time expense in year 1. And then in year 2 and 3, we didn't have any ongoing expenses in this specific business case. Now that's always important to keep in mind. So make sure you distinguish between your operational expenditure and your capital expenditure, your one-time expenses in this specific case. Now, in doing this, we're actively engaging in HR analytics, and there's a number of golden rules that you need to keep in mind. First of all, don't put effort into calculating a return on investment for things that are not important. Focus on the things that are important. Start with a problem that keeps management awake at night. In other words, what is your boss's problem and what's the boss of your boss's problem? And remember what we said in the part about strategic workforce planning and organizational strategy. Make sure that what you're doing is in line with organizational strategy, because that's usually the focus of the board of directors. Second, find and/or create a real business case. Don't focus on things that are intangible. Don't focus on things that you cannot change. Actively try to find and try to create real business cases that enable you to add value to the company. Third, focus on actionable results. I've seen people engaging in HR analytics and saying, hey, we have too many males and not enough females, so let's change males into females. Like that's kind of tricky and that's hard to do. Those kinds of results are not really actionable. Try to focus on business cases and try to analyze problems that result into actionable results, results that you can take action on. Remember the 20/80 rule, start small in every project and keep learning. Also when you're trying to calculate the return on investment for a project, start small, make the project as small as possible and then try to calculate the return on investment, and then you can slowly expand it, and that's way easier for you to do because you can spend time on calculating the return on investment on the core activities of that specific intervention, and it really helps you to keep learning. If you start small, it's easier to learn. Last but not least, be realistic. With everything you do, say, hey, does this add value and is this something we can actually actively change as HR? What if you need to quantify the benefits of a project? Quantifying the benefit will help you estimate the return on investment, but doing it is quite tricky. If you, for example, need to quantify the benefits of a training, it's hard to do it. Now, how can you do it? And the simplest answer is to use literature. Make an educated guess based on all the information you have. Another thing that's good to do is to measure the effectiveness of the intervention with a control group. So a third of the organization doesn't get the training, 2/3 of the organization does get the training, and you see, hey, is there a noticeable difference between the first group and the second group? And if there is, you can actually measure the effectiveness of the intervention and calculate the return on investment. Now keep in mind that many of the benefits occur over time. And that doesn't mean that it occurs over time for the next 100 years. No, it usually only occurs over time for a number of years. So try to pinpoint this and try to, again, use educated guesses and use literature to make this estimation. Another point is that the benefits can be hard, so that they can be financial, but they can also be soft. You can have benefits in terms of quality, less stress, higher happiness in the organization. Your organization is a better employer. Those are soft outcomes, and those soft outcomes can again be quantified into financial outcomes. A better quality product means usually more sales, less product defects, less cost in terms of recalls. So those are also quantifiable benefits, but they're usually harder to quantify. But do keep in mind that you have also soft outcomes that can also in the end transfer to a monetary value and that can increase the benefits of your intervention. And just like benefits can occur over time, some benefits need time to come to fruition. For example, if you do an absenteeism training, you really can't expect the beneficial effects to start at day 0. Why? Because people first need to do the training, then they need to change their behavior, then they need to maybe do a follow-up training, and then after their behavior has changed, the absenteeism of employees will change. So those benefits, the benefits of the intervention, need time to come to fruition.